Let's get into the advisory now. Retirement investing bringing new risks and requires a different approach, according to my next guest, with income certainty, longevity and flexibility becoming key priorities. Andrew Grinsell from Cooee Wealth Partners joining us now. Andrew, great to see you. What are we expecting in terms of how investing in retirement differs from, I love this term, pre-retirement?
Yeah, thanks for having me. So in pre-retirement, risk is mostly about, okay, will I accumulate enough in retirement savings? Whereas when we get into retirement, it's more about running out of money. And three new risks come into the picture for someone in retirement, and that is sequencing risk, it's longevity risk, it's inflation risk. And just to break those down a little bit, when we're looking at sequencing risk, we don't really have an issue with this whilst we're still accumulating retirement savings, but once we're starting to draw on them, the impact of poor returns early in retirement can do far more damage than poor returns maybe late in retirement. If somebody's drawing down on their capital when markets are down, that can permanently reduce future income. We've got longevity risk where we've got retirees just really underestimating how long retirement lasts. If you've got a 65-year-old couple retiring today, there's a very strong probability that one partner is going to live into their mid-90s. And then we've got inflation risk. And as we've been talking about quite a bit with some of the recent inflation numbers, it erodes purchasing power over time. And we might have investors who feel safe in cash and term deposits, but that can sort of deliver negative real returns after we account for inflation and tax. So we've got this situation where people still need a bit of growth, but also need to balance up their comfort with investment returns.
So Andrew, when should people start thinking about some of these risks?
Yeah, so for us, we sort of suggest that people start to look at it maybe 5 to 7 years out from retirement, and that's when this sequencing risk really starts to become material. At that point in time, we can start to adjust the asset mix, we can start to build in some income buffers, and we can structure the portfolio in a way that it reduces the reliance on selling growth assets at what might just be a bad time. Some investors might wait until retirement's already started, but if we do that, then we're taking a lot of risk in those final few years of retirement.
So when you think about a lot of those risks in retirement, you've got your own risk tolerance as well and risk capacity. What's sort of the difference here and how do you kind of navigate those?
Yeah, that's it. I mean, a lot of people look at risk just based on tolerance. It's how much risk am I comfortable taking? But we look at it from three different angles. And first of all, you do have that risk tolerance, which is somebody's emotional comfort with ups and downs in the market. But then we also have a look at things like risk capacity, which is somebody's financial ability to actually absorb those losses. And that can vary across investors depending on how much they've accumulated in retirement, what their other income sources are, how flexible they are with their spending patterns, and also their age. But then we've also got risk need, and that's, well, what sort of return do you actually need to generate to fund your retirement goals? And a lot of retirees will need some growth in their portfolios just to keep up with that inflation. So we can end up with these three different areas, sometimes being sort of not working together or combating against each other. And we've got to find that right balance where, you might have someone who is emotionally conservative when it comes to investing, but still needs growth assets to keep up with that rising cost of living. Whereas you could have quite a wealthy investor who can tolerate a bit more volatility because their lifestyle wouldn't be threatened by it.
So Andrew, talk about some strategies that investors can consider, because you touch here on time horizon investing, which is, as you say, flexible. What does it actually involve?
Yeah, absolutely. So one of the strategies that we like to use for clients is time horizon investing, or otherwise known as a bucket strategy. We like that because it is quite flexible. It's a strategy that's designed to manage sequencing risks, and it allows investors to have some allocation to growth assets, however, in a bucket that we don't really want to touch for quite some time. So it gives it the time to recover if there is a bit of a sell-off. So really that time horizon investing strategy is about having three sort of distinct sub portfolios, one that's there to be able to give investors whatever income and capital they need to access to fund their lifestyle over the next 3 years. So you build that as a very conservative, low risk portfolio. It's not going to go and create great, huge returns that you're going to go and brag to all your friends about. It's just there to cover those near-term needs. Then we can put in a medium-term portfolio that takes a little bit more risk and is really there to cover income requirements over the next 4 to 7 years, but not high risk, still giving it a portfolio that's got the ability to be able to recover within that 4-year time frame before it needs to be accessed. And then we can afford to put the remainder of the portfolio into a long-term bucket, which is a portfolio that we really don't need to touch for at least 7 or 8 years. And that can have quite a high exposure to shares and other high growth assets. So that way, if the markets do sell off, we've really got quite a long time frame for the markets to be able to recover before investors need to think about potentially selling those investments off, which should reduce the risk of having to sell at a loss.
So that's one of the flexible ways of doing it. Annuities, you say, a little bit of a lack of flexibility here. What does that involve?
Yeah, absolutely. We've got other clients that do use annuities, and it can work because it gives guaranteed income. It removes that longevity risk because they can be guaranteed for lifetime, and it can help people budget and spend with confidence. But it does have some drawbacks in that capital is largely locked away. Some of the newer products do have some flexible withdrawal periods, but the flexibility is a lot more limited than having a liquid portfolio. And it can be sort of less effective if income requirements change over time. What we see is a lot of people who will spend a lot more in the first 10 years of retirement, going and doing all of the travel and living the lifestyle that people have built their retirement savings up for, and then it sort of drops off over time. So there's definitely benefits to annuities, but there is that lack of liquidity. What we've done for a lot of clients is actually blended the annuities and the time horizon investing together so that clients know that they've got an absolute bottom line level of income that they should not drop below. And then we use the time horizon investing to give the flexible component of the portfolio on top.
Do you find people sort of looking at their retirement and maybe also factoring in the Centrelink age pension or feeling like the government is going to catch them? How does that all play into retirement planning too?
Yeah, we do. I think the confidence with relying on the age pension really varies depending on how close somebody is to reaching age pension age. Like, for most investors who are in their 50s, we're not really talking about any sort of age pension because we just don't know what it's going to look like exactly by the time they get to 67, or even what age that might be when they get there. It could be an older age qualifying. Things can change. But for those clients that are sort of at age pension age, what the age pension can do, even if they don't qualify for it right now, is it gives them a bit of a safety mechanism. They know that if they spend down their assets, the age pension would kick in and increase. So therefore, if they go through and they have they spend more money than what their investment returns are earning, so their portfolios are going down in size, the age pension starts to kick in and do more of the heavy lifting, which then allows them to sort of slow down how much they're actually drawing off their own retirement savings over time. So sort of for every $1,000 your assets go below the age pension cutoff limit, investors, a retiree would pick up about $78 a year in pension payments.
All right, so Andrew, the crux of it is we should be planning for retirement, I guess, as early as we can.
Yeah, the way that we tend to look at it is when we're doing retirement planning, we can't avoid risk. Market corrections are going to happen. Things that we just don't expect are going to pop out. So what we need to do is just structure retirement portfolios in a way that can withstand those risks and those additional risks that we're picking up in retirement that we don't necessarily have to worry about whilst we're still building our retirement savings.